This is not a theoretical discussion of balance sheets. It is an examination of financial alchemy, a grand, global magic trick performed daily that underpins the entire modern world. The United States government funds itself through a bizarre, closed-loop mechanism that would, if attempted by any private citizen or corporation, land them in jail for fraud. The core absurdity is this: the borrower has invented a way to guarantee demand for its own debt. The U.S. Treasury, representing the government, borrows money by issuing bonds, essentially IOUs backed by the nation's full faith and credit. Then, through its own entity, the Federal Reserve, the government effectively steps in as a buyer, creating new digital money out of thin air to purchase its own debt obligations. This is the Ouroboros of Finance, the snake that perpetually consumes its own tail. And its longevity is the central paradox of the 21st century economy. The question is how long this magical, self-perpetuating illusion can continue before the circle breaks. To appreciate the trick, one must first understand the bedrock of global trust, the government bond. From the moment Alexander Hamilton, the nation's first Treasury Secretary, convinced a deeply divided young republic to honor its Revolutionary War debts, the U.S. has been locked into a credibility gambit. Hamilton understood that to become a great nation, the U.S. had to prove it was a good credit risk. By issuing new bonds to cover old debts, he successfully established the faith necessary for investors to keep lending. Since that foundational moment, the American financial lifeblood has been a cycle of borrowing, servicing, and rolling over debt, with the government confidently spending more than it collects in taxes, secure in the knowledge that the world will line up to lend to it. The real transformation of this system occurred with the establishment of the Federal Reserve in 1913. Designed initially to stabilize a chaotic banking system and prevent panics, the Fed soon evolved into the government's invisible partner in sustaining debt. During World War II, the Treasury needed capital mountains to fund the war machine. The Fed stepped up, agreeing to buy government bonds whenever necessary to keep borrowing costs artificially low. This was the practice run for the Great Trick. The government had discovered a way to guarantee an endless demand for its debt, backed by the Fed's ability to simply create money. The true global metamorphosis occurred in 1971. Before that time, the dollar was still nominally tied to gold. Foreign governments could, in theory, demand a physical exchange of their dollar holdings for bullion. But the costs of the Vietnam War and expanded domestic social programs ballooned the debt, draining the nation's gold reserves and shaking confidence. President Richard Nixon executed the anchor cut, unilaterally severing the dollar's link to anything tangible. This was not a minor policy change. It was the quiet revolution that ushered in the age of pure fiat currency. From that moment forward, the dollar's value and the faith in the Treasury bond rested entirely on trust, the world's collective shared belief in the stability of the American promise. The constraint on debt was no longer a finite resource, gold. It was a fragile psychological variable, faith. This set the stage for the perpetual motion machine of modern quantitative easing, or QE. When the Treasury needs trillions to cover its deficit, because raising taxes or cutting spending is politically unthinkable, it issues its debt through auctions. Usually, large players buy them, foreign governments like Japan and China, massive pension funds and investment banks. But when demand falters, or when the government needs a sudden, colossal injection of cash, as during the 2008 financial meltdown or the 2020 pandemic, the Federal Reserve activates the digital printing press. The Fed doesn't need to dip into savings or generate profits. It executes an accounting maneuver, typing numbers into existence on its balance sheet, and uses those newly created digits to purchase the government's bonds. The Treasury sells the debt, the Fed buys the debt, and the money floods the system. The U.S. has, in practice, financed itself with invisible capital, creating a silent backstop that keeps interest rates low and enables deficit spending on an unimaginable scale. The winners in this game are obvious. Politicians get to spend lavishly without incurring the political fallout of tax hikes. Wall Street banks and the asset-owning class get a continuous supply of liquidity, which props up asset prices, leading to the K-shaped recovery where the rich get richer while the poor struggle. Foreign governments, for now, continue to hold the debt because they need the dollar for global trade. But the losers, the silent majority victims, are the ordinary citizens. The perpetual motion machine is not frictionless. It generates massive thermal leakage in the form of inflation. Every new digital dollar created by the Fed to buy a treasury bond dilutes the value of every existing dollar in circulation. The bond trick is made possible by the quiet, regressive transfer of wealth that is the inflation tax. When grocery prices soar, when housing becomes unattainable, and when your savings account yields less than the rate of erosion, that is the invisible cost of the central bank's actions. Inflation is the tax that was never voted on, a structural mechanism that funnels purchasing power from ordinary people holding fixed wages and cash to the government and asset owners whose holdings appreciate in nominal terms. The U.S. maintains this extraordinary advantage due to the exorbitant privilege of the dollar's role as the world's primary reserve currency. The global economy runs on the dollar. Oil is priced in it, the petrodollar system, and international trade is settled in it. This creates a stabilizing flywheel effect. The world must hold dollars to conduct commerce. And the safest place to store those dollars is in U.S. Treasury bonds. This mechanism guarantees artificial demand for the IOU, granting America a degree of financial freedom no other nation possesses. But the flywheel is slowing. Cracks are appearing in the foundation of trust. Countries within the BRICS bloc are actively exploring alternatives to the dollar. Central banks are diversifying their reserves, with gold accumulation hitting record highs, a quiet signal that nations are hedging against the reliability of the dollar. The growing whispers of de-dollarization suggest that the world's appetite for endlessly financing American borrowing is waning. If the global market collectively decides that the IOU is no longer the safest bet, the entire loop could unravel with terrifying speed. History provides stark warnings about what happens when this trick runs out of trust. In Weimar Germany in the 1920s, the government's attempt to cover its debts with the printing press led to hyperinflation. That wiped out an entire generation's savings overnight. In the 1970s, after the gold link was cut, the dollar's value collapsed, ushering in a decade of double-digit inflation, gas lines, and economic malaise in the U.S. itself. Every great empire, from the Roman emperors who debased their coinage to the British Empire, whose pound retreated after 2 world wars, ultimately succumbed to the irresistible temptation to solve political problems with financial tricks. Debt can fuel empires. But eventually, the trick runs out of trust. The real danger is not just inflation, but the fragility this structural dependency creates. If foreign buyers retreat en masse, the U.S. would be forced to finance its debt almost entirely domestically, necessitating a much heavier reliance on the Federal Reserve. This would amplify the printing and dramatically spike inflation, imposing a crushing, unavoidable cost on the American populace. The system is structurally sound only so long as collective faith remains absolute. It is a tower of Jenga, massive and impressive, but resting on the single, removable block of global trust. This is why understanding the bond trick is not a matter of abstract political debate but one of personal survival. It exposes how money and power are inextricably linked, how hard political choices are consistently avoided by shifting the cost to the future, and how the debt inevitably climbs regardless of which party is in power. The machine is structural, non-partisan, and self-serving. The only defense against a system designed to transfer your purchasing power to the financial elites is to understand the rules of the game. When the illusion finally breaks, it will not be Washington or Wall Street that pays the price. It will be the millions of ordinary citizens whose savings and wages were quietly drained by the hidden tax of the self-financed empire.